Okay, anybody remember cap rates? Okay, $100,000 divided by a 5% cap.
Drum roll, please.
How much?
$5 million in value.
So all that from Oakview doing that. And also to tell you, just to expand a few things. First off, Vicki has been our director of property management for the last 5 or 6 years anyway. So stepping into that position is no big deal. She's already been handling it. The staff is here because they want to know what they do and how what they do affects you guys. I also want them to see you and say, hey, these are just regular people that are the investors in the property. I tell them that all the time, is these are not some big company that is providing all this capital. It's regular people investing their life savings into these assets. And so they are in control of, how much is the total portfolio worth?
Well, you're talking about...
Well, $150, $200 million, somewhere in that range.
Yeah, in equity, yes.
In equity?
Yes.
Okay, so that's the amount of equity that they're in charge of. And I'm looking directly at them to realize that's a lot of freaking money, okay, that you guys are in charge of. And so it's real important. So if you want to meet anybody that is taking care of your asset, then they're here to go ahead and say hello to. And we're going to do back to the basics. And again, Brian, thank you so much. Worked your ass off, very dedicated, unbelievable. Thank you so much. So since we're a little bit behind schedule, was there anything else you need to say real quick?
No.
No, thank you. Go. Okay, so back to the basics. We're doing this just to, is there anybody that is relatively new to investing in real estate? Oh, come on.
It's okay.
Okay, good. So I want you to understand how it all works and in the whole process. Because if you understand how it works, quite honestly, you'll be happier with your investment rather than just, I hate stocks and bonds and things like that because, oh great, it went up or down. What the heck does it matter? And how did it work? What happened, etc. So we'll go through this real quick. First off, it's the ideal investment. You've heard this before. I for income, D for depreciation, E for equity buildup, A for appreciation, L for leverage. But then we also add a few more in here. That's a pretty normal thing that they talk about, being the ideal investment. We'll go through those in detail. But also control, no stock market risk, market cycles, and risk. We'll talk about those in detail here real quick. First off, income. Obviously, tenants pay rent. We pay all the expenses, and then you get cash flow. Who likes cash flow? There we go, okay. So now we know that some people will never raise their hand, no matter what we ask. Depreciation. Does anybody know the benefit of depreciation? It lowers your taxable value. So if you're making a 5% return, but you have depreciation that offsets that, so you don't pay any tax on that 5% return because it's already calculated. So if you're comparing apples to apples, if you get a 5% return on anything else, then you pay taxes on that, then that subtracts from that 5%. Whereas in real estate, the way that we do it, you will actually get a deduction on that, so that is your net. So it's the equivalent of getting more like 8%, depending on your tax bracket, okay? So huge things. And that's with straight line depreciation. We also do straight line, means it's in residential real estate over 27 and a half years is what you depreciate it over. We've got accelerated depreciation, which everybody loves because then we can get more depreciation faster for a bigger write-off. And bonus depreciation, which is going away. By the way, it's only 80% right now, and I realize I'm saying that, and some of you don't have a freaking clue what I'm talking about. Bottom line is depreciation is great for us tax-wise, okay? Equity capture, okay? Julian was talking about the mark. because of how this thing is structured, it's really unbelievable. We're paying roughly $80 million. It already did appraise, I think, for $96 million.
95.8 million.
Okay. So think about this way. We're paying $80 million for something worth $96 million. Is that a good deal?
Yes.
Okay. And if we're raising $16 million and we've already got $16 million in equity, that's a 2x multiple on paper day one, which is also why I very much dumb down our returns. Okay. Now, equity buildup over time. If you got an amortizing loan, that gets paid down, and it also properties appreciate and build up equity on that side, equity buildup. Appreciation over time, properties go up in value. Again, we talk about it being a yo-yo on an escalator. Market cycles will have it going up and down, and we do everything we can to protect from that downside, which is why we don't have any risk on interest rate. On that note, I'm going to tell you a quick story. A portfolio in Houston. A group raised $80 million to buy this particular portfolio, $80 million in cash. And it closed, I want to say, last February. Okay. They had private equity. They defaulted because the interest rates went up. They defaulted on their loan. It's only been a little over a year. Private equity came in there, foreclosed, wiped out $80 million in investor capital. Okay, that's what's going on out there. Okay, that's what we protect you from. Okay, four of them totaled $229 million. Yeah, insane, just gone because you get foreclosed and it's gone.
And they also had capital calls of 100% of the original investment.
Those did or somebody else?
No, those guys.
On those, okay, to save it, Nikolai was saying that they did cash calls to save the property of 100%. So if you put in $100,000, you would have to put in another $100,000 to protect your investment. And instead, they decided, you know what, we can't raise that money, and walked away. So that's...
And the guy in charge fled the country.
Oh, really?
Yeah.
I bet he has death threats off of $80 million. The guy in charge had death threats and moved out of the country.
About death threats,
No, he doesn't know about death threats. He moves out of the country, so I apologize. I know if I was there, there'd be death threats. Then there's also forced appreciation. This is really nice because we can actually, because we know what we're doing when we look at this, it's like buying a fixer-upper. You know how to increase the value of that property. So we do forced appreciation, not just buying it and hoping it goes up, but we can actually do something. That's where that control comes in. We can buy it knowing that management's bad or not completely on the ball. We can fix up an asset. We'll go through all those numbers on how all that works. But it's bottom line, raising income or lowering expenses, which creates additional value. Leverage. Leverage is a huge benefit, and this right here explains it real quick. If you have $500,000 and you buy stocks, bonds, gold, whatever, and it goes up 10%, you made $50,000. So you made 10%, right? However, you put that $500,000, do 25% down, and buy a $2 million asset, and it goes up 10% in value. Then it went up $200,000, so you have a 40% return. That's the benefit of leverage, okay? That allows you to make money faster. Control, we can affect the performance of the property. No stock market risk, a lot of people like that. Stock market, who's in the stock market? I don't even look, how's that doing? 30% How much? 30% down last year. Oh my God. That's horrible. Okay. Market cycles. Values fluctuate, but cash flow continues. I'll talk about that later also. It's a tangible asset. It's actually a hard asset. Rents increase, expenses increase, protection from inflation. Even though inflation will cause expenses to increase. It causes rents to increase. Also, cost of construction goes up, so you won't have additional competition being built at the same level. So we always like that. That's why we don't build too much, is if we can buy a property that's for $100,000 a door, but it costs $200,000 a door to build it, we know that our rents have to go up enough to justify $200,000 in construction costs. So we know our rents are going to have to go up so we can keep up with that part of it. It's also shorting the dollar. Last year, if you had a 4% loan, and let's just say we had 8% inflation, you were making money right there on that arbitrage. Okay? Also, the higher interest rates. Who are residential realtors in here? Well, there's a couple of them. Sales drop off. Listings drop off. People can't afford to sell. They can't afford to buy either, which are going to keep people in apartments, which increases demand, which increases our rents. Also, higher interest rates keep out developing. On a side note, I put this on here. Shorter leases allow us to react to inflation faster. So in an office building like this where you have 3-year leases, we can't adjust them for 3 years. But in apartments, we can do it every 6 months or a year, depending on how long those leases are. Risk. Interest rate is a risk. We just talked about that. And we can mitigate that with proper deal structure by having fixed rate loans, which is what I've said the entire time. These are concerns that other people say. What happens if there's a fire, a flood, a death, a tornado? We've had tornadoes hit properties. There's not much risk in that because we have insurance that covers it, and they build back brand new units, and they pay us rent on those units while they're being worked on. No risk. Okay? Market fluctuations. We mitigate that with experience management and cash reserves. The market is down right now. So we have you protected because we have enough cash reserves to go ahead and ride that. We've got debt that's in good position, plus being around for over 30 years, we've been through market cycles and we know how to take care of the assets in those cases. Now we'll get into who invests in single family residential. Okay? A few of you. How many in multifamily? How many don't but want to? Okay. Make sure to mark those people. No. Okay. If you buy a house for an investment, you've seen every fix and flip show out there. I personally love the one with the guy in the listed, or what's it called? Love it or list it. I love that one. I like those two. But it's a single family property is only worth what the sales comps are. So you look at your house in your neighborhood, no matter how much money you put into it, it's pretty much only going to be worth what the houses around it are worth. Okay, so you can over improve a house. Okay, of course, I'm doing that on my own house. I'm over improving it, but that's okay. There's another benefit to that on your own personal residence. So there's limited value. You know what it is. It's pretty simple, easy, and fixed. But you can't go too far off that. Plus, there's no economies of scale. You have one house, you have one renter, they move out, you're 100% vacant. So you need to have numerous. Investment property is the valuation is based off of the income. I'll show you that in more detail in a minute. So it's got greater value proposition, so you can actually raise it up more. You can actually have sales comps that are at one level, but another one could be a lot of. I'll give you an example. This building here. Buildings in this area, I don't know what they sell for. Let's just say they sell for $100 a foot. This building could be worth $150 a foot because of the income it generates. For example, on this property, because we self-manage and we're on site, that gives us a competitive advantage against everybody else. If you're moving your office into a building, you're a little more comfortable and a little bit happier that you have on-site management and ownership to take care of you. Plus, we improve the lobby, we improve the property to increase the rents, which increases the value of the property. So it can go up higher than the market. You have economies of scale and you have professional management as well. Income producing properties are only worth the income they produce or can produce. And you got to remember, what you're really doing is you're investing in a stream of cash flows. It's an investment. You're not going to live there. But what it is, it's the security for your investment. Okay? So that way, if you buy stocks, bonds, gold, what is the security for that? Whereas you have a hard asset in real estate. And it's a great hedge against inflation because it'll keep up and exceed inflation usually. Two types of deals. Am I going too fast? Two types of deals. There's a value deal and a yield deal. A value deal, those are the ones that are the sexy ones. Those are the ones where we have a lot of forced appreciation. We know that we buy it for $100,000 a door, we put $20,000 a door into it, and it's worth $150,000 a door. Okay? So we know we can buy it, fix it up, and increase that value, and because of that, you've got a lot of forced appreciation. That takes more work than buying a yield deal. A yield property is already stabilized, it's already 95% occupied, it's already running smooth, and the people that like those are hedge funds and insurance companies and extremely large investors because they don't want to go in and put the hands-on work into that. They just want to buy that stream of cash flow. Okay? However, as I put on here, value, there's upfront risk because you're buying a property that a lot of times might not cash flow. It might seem overpriced for the income. It might have a cap rate that's 0. But so there's upfront risk when you buy that to get you through to wherever you're going to go. However, with a stabilized deal, in my opinion, all it can do is go down. It's already 95% occupied. Are you going to increase rents? Are you going to increase occupancy? What are you going to do to increase the value? You really can't. So the value add is the sexy one everybody likes. Also because in the past, we've been able to hold it for between 1 year and 3 years, refinance it and take cash out tax-free because we dramatically increase the value of the property. How many of you have been in one of the refinances? Nice, fun, huh? Syndication. What we do is syndication. Basically, we marry up capital with experience. You're investing in a team, which is our team that takes care of the asset, and our experience is what you're investing in with the security of being the real estate. That's where you're investing. You're investing in an LLC that owns a piece of real estate that's not spread out. It's a single purpose entity. You're only in one property, and that is the asset you invest in. Which is also why if somebody comes in and say, we've got $500,000, I say spread that out over numerous deals so you don't have risk in one. Okay? Because some of the returns have been huge, some of them have been through the roof, some have been average, and but all over the place. As a matter of fact, you can see our new pictures up on the wall. We actually put all those up with the returns we got on those and all of the different assets. So Julian actually hung those personally.
Hey, I'm gonna bill you.
That's okay. That's okay. Also, because of doing syndication, you then have the ability to invest in deals that might be out of reach, either because of the amount of capital or not having the relationships, et cetera. And then also, you're not going to get the call regarding the oven not working on Thanksgiving or the toilet not working in the middle of the night or anything like that. So you don't want to have to fix all that junk. You have a team that goes ahead and does it. I'll go ahead and do this real quick. Why invest? You're concerned about your financial future, fear of the stock market, not enough income. Here's what's funny. I wrote this slide 5 years ago. I've got the rest of these slides that are from here on out. I've got a bunch of blank ones, but we're not going to go through them. From a presentation I did over 5 years ago, and it still rings true. Fear of the stock market crash, not enough income, not enough time. Tired of trying to save money. You're not going to save your way to retirement. No path to retirement. You feel like you're going to work till you die. You're tired of paying too much in taxes. By the way, that depreciation that I talked about, that tax benefit, that's not just for that asset. you can use that to offset other gains on other investments. So that way you can lower your overall tax due. You want to have some type of financial legacy to leave to your kids. Bottom line is we're here to help. That's why we do all this, is it's mutually beneficial. Of course, we make money on it. We employ a whole team. And that's really what it is to help. We help each other. Without you, we can't do what we do. So that's extremely important to us. Okay? Here's where we get into the nuts and bolts. This is extremely simplified. This is where I want you guys paying a lot of attention, okay? Because all of this is affected by what you do, okay? And I want to show you how that works. Bottom line, this is the magic formula. This is all it is. The operating income minus the operating expenses equals your net operating income. So that is the income and expense for the stuff that happens on the property for the property. This doesn't include debt service. This doesn't include insurance proceeds. This doesn't include a lot of other things. That's what we call below the line. All of that happens to the property is what we call above the line. Okay? Magic formula, operating expenses. Income minus expenses, net operating income. The NOI divided by the cap rate is the value. So in this equation, $1,045,000 is worth $20,915,000. So this property, based on a 5% cap rate, is worth almost $21 million. Okay? That's all you know. You don't have any other information, and you can see what that is. Talk about cap rates for a minute. A capitalization rate, simplified, is if you paid cash for that property, that's the return on investment you would get. Because there's no debt service, anything else. It's an oversimplified way of saying you're going to earn 5%. The cap rate then allows you to compare that investment with other investments. Okay? Now I tell you that because everybody will ask you, oh, what was the cap rate you bought at? What cap rate is that? What? Cap rates are bullshit. Okay? It doesn't really matter. You don't know anything else against this property. I can completely fudge any of those numbers and affect that value based on that cap rate. So it's junk. If people say, what cap rate are you buying at? I don't have a clue. I don't look at it at all. I look at the yield that the partners are going to get. Ruh-roh. Okay. Okay, so that's the magic formula. You understand that? Operating income minus operating expenses equals NOI. NOI divided by a cap rate is value. Yes, sir?
So isn't that 5% the yield if those numbers are correct?
Yes, absolutely. If those numbers are correct and you paid cash for the property, then you would pay $20,912,000 and you would get $1,045,000 a year in cash flow. So that's a 5% return on that investment.
So the cap rate's really just the multiplier of whatever NOI was given to you. And the yield is how much you make on the money you put in reality. It's not affected by the sales price. Well, it is.
Okay, who is a stock guru? Anybody in here that really knows stocks? Okay, nobody brave enough to raise their hand. Have you heard of EBITDA? Okay, earnings before income taxes and amortization. That's what that is. It's the same thing as EBITDA. It's earnings before interest, taxes, and appreciation, and amortization. Okay, so that's the same thing.
Taxes are included here, property taxes.
No. Income taxes, not property taxes. This does have property taxes. In the EBITDA that we're talking about is the income taxes because that's going to be different for every person.
Let me jump in here real quick. So who has sold a home, whether it's your personal home or a rent house, in the last year or so? Okay. So when you have the broker come over to your house or to your office, what have you, one of the things they will tell you is, well, Mr. Jones, houses in your neighborhood. Oh, Susan, you sold one not too long ago, right? So did they not tell you houses in your neighborhood are selling for about $240 a square foot, right? That's what that is. Oversimplified, but that's what that is. So in this market today, for that class of property, that is what equivalent of per square foot these properties are selling for. That's more or less what a cap rate is.
Let me expand on that a little bit confusing on that. The cap rate, is what he's saying, is the market for that particular asset. Just like the market for your house might be per square foot, that's the market for an investment property.
Yes.
Okay, just saying it a little bit different. Okay, now, where do those numbers come from? Okay, so let's go through that. We're going to start off with operating income. Okay, operating income, gross potential rent. You guys all know what that is back there? Okay, okay, so everybody else may not know what gross potential rent is. So we start off with that one and say, what is gross potential rent? Well, let's move over here and show you that this is what they call a unit mix, okay? In this particular property, if there's 21 bedrooms, 52 bedrooms, and 33 bedrooms, with the square footage, which doesn't really matter, doesn't affect any calculation, the rent's $1,200, $1,350, and $1,450. So if every one of those units were leased at the market rate, it would create $135,000 a month. You follow that? Okay. So that $135,000 a month times 12 would give you $1,620,000. Now, how many properties are 100% occupied at market rent and everybody paying? God, that was a loud cackle back there. Which property is that? Okay, so now, you got to calculate in there, you got vacancy loss, which is physical vacancy. How many units you're not collecting any rent on? So the longer those go vacant, the less revenue you're going to get. So we try and focus on turning those units real fast. But we also have collection loss. And that another way to say that is, well, collection loss includes people that just didn't pay their rent, and also the difference between the market rent and the lease rate rent, okay? Because what's funny is, even if everybody was paying 100%, if all of the leases, if every one of those leases were exactly that, and I raised the rents on paper, I say market rents, and I raise them all up 10%, okay? Did any of the lease rates change? Not a single one. That's only for future leases. So all of those previous leases now have a loss to lease. So I'm going to go ahead and say this one too. Gross potential rent is kind of crap as well. Okay? Because it doesn't matter. Brokers will say market rent for that one bedroom should be $1,500 a month. Well, they're salespeople and they go pull the best comps and say that. So it's really a kind of a nebulous number also. But that's why we do market surveys. Are we doing them twice a month now? Twice a month market surveys, so that we can adjust our rents as we need to. Okay, but that's gross potential, okay? Gross potential rent. Now you got to subtract out vacancy and collection loss. Now, if you analyze a property, you can look and see what income they're actually collecting, okay? So this could be gross rental income. That's the income from the rents only, okay? $1,425,600. If I'm analyzing a property, I put in their actual collections there to calculate their vacancy and collection loss. As I'm projecting out for the next couple of years, I put in a hard number on that, 8%, 9%, 10%, whatever it is, so that it calculates for me so I can see where that income can go up to, okay? Other income. Other income, here's $353,000. Here are just some of the ways that we get other income. Just a few. Okay, real important. For every $1 you increase that net operating income, you increase the value of the property by $20. $1 net income increases the value $20. Okay? So, if you call out a plumber, now I'm speaking to them a little bit, you call out a plumber and it's $1,000 to fix that repair, but you could have done it in-house for $500, that $500 savings, right, that $500 extra you spent, just reduced the value of the property by $10,000. And you think, oh, it's nothing, we'll just call a vendor out. That one repair, if you could save $500, cost $10,000 in the value of the property. Dramatic. Okay, but all of these other income, application fees, holding fees, carport rent, storage rent, rubbing back water, reletting fee, pet rent, so many things. Yes, sir?
I'm just curious, what is eviction income? How do you make money on eviction?
How do we make money on eviction income? Let's ask, hey, Vicki,
Yes, sir.
eviction income, what would go into that?
We charge back residents if we are evicting them and we have to pay a fee, so we charge the resident back for that eviction.
So if somebody doesn't pay their rent, we have to go file for eviction. I think it's $135. It's still $135. Have to pay the court $135 to file that eviction. Now the resident comes back in and says, hey, I'm going to pay my rent. We say, well, now you have your rent, plus you have a late fees, plus you have the eviction income. Then that's where it gets categorized.
That's if they pay. If they don't
That's
pay,
if they pay, yes. Yeah, and this is just what they actually pay.
What is the rubs?
RUBS, it's a bill back. So we take electric, all bills paid. Water, sewer, trash, pest control, all of those, and we clump all those together and then spread it out across all the units and bill them back for that. Okay, and it's whatever we can get. Vending machine income, whatever. So anything we can get in there. Again, $1 in additional collections adds what value to the property? $20. And that's at a 5% cap rate. Okay, so that's where our other income comes in. So our gross potential rent minus our vacancy and collection losses, our gross rental income, plus our other income gives us the part of our magic formula, our operating income. You follow that? Pretty simple? Okay. Now, you also have operating expenses. Okay, we've got 10 categories that we usually use. Repairs and maintenance, contract services, utilities, marketing, general and administrative, insurance, property tax, payroll management, for a total in this of $733,000. I put in a per unit over here because we look at it per unit to be able to compare one property to another. So if we're looking at a property and they are spending, like on this particular property, payroll, and they're spending $100,000 a year, that's only $1,000 a unit. We kind of go, can't afford, that's not realistic. There's something going on there. So we have to put in what is market. Property taxes is the huge one, and because we have to adjust that. But we look at all these numbers and say, is it in line and realistic? So those are the expenses. Anytime we can do anything to save money, now we look at capital improvements come in there for, if we spend money on capital improvements, that helps increase the rentability and the rent, increasing our gross potential rent. But it can also lower expenses. For example, we did a project where we replaced all of the air conditioners. This was an all bills paid property, okay? So we look at a return on investment on that. If we spend $500,000 on that project to go ahead and do this, can we lower the expenses by an equivalent amount so that that makes sense? Some people might say, okay, if you spend $500,000 on something, how soon do you want to make that money back? How many years do you think that should take to get back? Anybody?
3 to 5.
3 to 5 years. Okay, so $500,000, and so you want to save $100,000 a year. Okay. What about cap rates? $100,000 would increase of savings would increase the value of the property by $2 million. Did I do that calculation right? By $2 million. So you invest $500,000 to make $2 million. Now, usually you don't have that good of a return. It might be over 10 years. But still, over 10 years, $50,000 a year, now it increased the value of the property $1 million. So you still get a 2x return on that.
Darwin?
Yes?
One of the advantages due to the CapEx is that it lowers the expenses, which increases the NOI, and that's what the valuation of the property on, and depreciation is below the line.
And depreciation, yeah.
So you get the offsetting effects of that.
Well, yes, if we get into taxes on that, it's a little bit deeper than I want to go on taxes on where we do that. Because, actually, I'll hit that real quick. Accountants will understand, will know this part of it. If you have a property and you're replacing the roof, for example, let's just say it's $100,000 to replace that roof. Technically speaking, that doesn't even show up on your financial statement. That only shows up on your balance sheet because it's an improvement that you then have to depreciate over a particular term. Okay? Now, if you did a repair on the roof, if you repaired the roof for $100,000, then that's an expense in your operating expenses that would lower the value of the property, but also lowers the taxable value. You write it off 100% that first year. So it's in your house, you fight the property tax value of your house, right? You might have seen the cartoon, what your house looks like to an appraiser, and it's a mansion. What it looks like to your buyer for realtors, and it looks like a shack. What it looks like, so you've got different competing different views. If we are going to sell a property, and again, I'm going back there. If we're going to sell a property, we want our NOI as high as possible. So we would capitalize that particular item. We would replace it rather than repair it to keep our NOI high. However, if we're not going to be selling the property in the near future, we want to expense that. Okay, you follow? So there's different motivations on how you do different things to affect that value. Follow? Okay. Going back, then that goes over to that same magic formula. Now, let's just say that this, so all that feeds into this simple part. When you look at our financial reports and everything, there's our projections, our PPMs, there's all sorts of numbers. And how many of you don't understand that? Look at the bottom line, how much money am I going to make?
Everybody.
Everybody, right? That's why we put it in there, okay? Because if you have to figure out what all that is and if it's going to be good or bad, we put it in there so that those analysts can look at that and understand it. But bottom line, hey, if I put in this, what can I expect on returns? Okay. So let's take this property and, in that cap rate it's worth $20,912,000. Let's assume that we're buying it for $20 million. We're going to have closing costs of $1 million, puts us all in at $21 million. Okay? So that's our total investment with debt and equity and everything. But we can go ahead and get a loan for $14 million, leverage. Remember the benefits of leverage? So our investment's only $7 million. Okay? That's the $7 million that we get from you guys. That's a lot of money that you're in charge of. Okay? So $7 million is what we raise. Okay, now let's take that debt of $14 million. This is below the line. Remember our net operating income was $1,045,000? Let's just say the debt service at 5% interest only is $700,000. We have company expenses. This is not an operating expense. This is asset management. This is tax returns. This is, what else would be underneath there, Julian? Accounting fees, anything else. Stuff that doesn't go to the direct operation of the property, okay? Non-recurring income and expense. This could be technically refrigerators, carpets, flooring, all those things should be capital improvement items. So it can either be, Dillard's going to kick me for this one probably. You should have a standard that says if it's a replacement under $500, then it's an operating expense. If it's over $500, it should be a capital improvement item. Okay, and that's what that non-recurring, we count it as non-recurring, because if we replace a carpet in that unit, we shouldn't have to replace it for another 5 years. So we say non-recurring. However, we're going to have carpets every month. Okay, but putting it down there below the line then gives us a way of keeping the income up. So it gives our cash flow of $285. So if we put $7 million down, the return on investment that year one is 4%. Okay? Now you got to remember that 4%, $285,000 in cash flow. If the depreciation gives us a $542,000 tax write-off. So when you get your K1 on this, it shows a loss. Even though you received cash of, even though the property received cash of $285,000, you're going to show a $256,000 loss. Okay, so you look at that K1, oh my God, I lost $256,000. No, you say, yes, I lost $285,000 because you get to write it off because you already have the cash flow. Okay, you follow? So that, now that $256,000 loss can go to another property. Okay, now, everybody followed all that, right? Because there will be a test. Okay, let's do this. Let's play with this a second. We said that the value of this property, I'm going to go ahead and say $20,912,000. Okay, so you said that's not going to change. I put a fixed number there. Let's just say this is why it's important to raise the rents, and we got to push on raising rents. And I know it's difficult. Quite honestly, managers don't like raising rents. And the reason for that is it makes it more difficult. Because now you have a lease turnover and you've got to release it, your numbers look bad, etc. So we understand that. So they think it makes them look bad, but we understand the yin and the yang on how there's an art to how much you raise. Let's just say you can raise the rents $100 across the board, okay? Is that a huge increase? It's pretty good. It's not horrible. I mean, it's not ridiculous, but it's not easy either. That took our gross potential rent to $1,740,000. We still have 12% vacancy and collection loss. Nothing happened with our other income, but our operating income went up. And so now the value of the property is $23 million. We just increased the value of the property by $2 million with $100 rent increases. Magic. Magic with numbers, just simple. Okay, you just created $2 million in value by raising the rents $100 across the board. Great deal, huh? Okay. Yeah, you like that, right? Now let's, but then you can also go over the same thing in expenses. I'm going to use this one again. Okay, now we're at $23 million. The mark, what we're doing on the mark is we're taking out property taxes. The property taxes on the mark are $1,250,000, by the way. So this is a different number. So if we can do a PFC on this and take out property taxes, which we can't do, this is just an example, I just want to show you that if we lower that, what's the value now? $27 million. Added another $4 million to the bottom line because of getting rid of that property tax. Now, that could be reducing payroll, reducing insurance, reducing marketing or utilities, okay? On this particular property, by the way, utilities, $1,650. Something that we do is water savings.
Oh, that's sexy. Oh, we're doing toilets.
That is so sexy, you love that? We're gonna put in low flow devices on the showers and on the sinks, put in new toilets that are harder to flush, you know. We're going to do all this stuff. This is all fun, okay? But we are going to lower the utilities by $30,000, okay? We were at 23 million. So that little bit just increased the value of the property by $500,000. Boom. Just by saving just a little bit. And there's a whole lot of little bits that add up. A water leak. We have to identify that soon because if that keeps on leaking, then it's going to cost us money, okay? And which lowers the value of the property, okay? So we're at 23,624 right here. This cap rate is about a 5% now. A year ago, year and a half ago, oh, we can go lower than that. Let's just go 4. 4% cap rate, okay? And again, cap rate really means nothing, but people look at it and understand it, and it is a way of valuing. So if that's a 4% cap rate, we go from 23 million to 29 million, okay? However, we were at a 4 last year, now we're at a 5. What happens if cap rates go from 5% to 6%, okay? The property goes down in value by $4 million. Okay, that's on paper. Does that change, did any of that change your cash flow? Not a single thing. So the market will go up and down on your valuation of your property. Kind of like looking at your stock portfolio. You watch it go up and down and up and down, and then you do that for a few days or months or weeks, and then you say, screw it, I don't want to look at it anymore. Yes, that's what I did. So your NOI doesn't change. Now in a market crash like we had 2008, values went way down. Rents only went a little bit down. So you still had cash flow. So that's part of the structure that you do is you prepare to ride through times like this, okay? Let's go back to that 5%. Here's something else that's happening, okay? Let's just say, because we've got a 5% debt service here. Oh, crap. Let's just say that's 5% interest only. Let's just say that the interest rates go up. For example, there are 4% loans that they got last year that are now 8%. So it is completely possible that in a year rates could double, okay? So we were at cash flow of $421,000. Interest rates went up. What happened? That's how come people are in trouble right now, is the interest rate went up. I have been saying for 20 years, fixed rate long-term debt. It protects your downside. Now, over the last 10 years, I've looked like a schmuck because interest rates kept going down and down and down, and my interest rate's here, but now it's here. Okay, so I looked like a fool until last year. Now I look like a hero. But I do that for your protection. I mentioned this on Brookside, another property that we had. Our prepayment penalty on the property was $5 million. Okay? $5 million was our prepayment penalty because we had fixed rate debt and interest rates went down and they had to replace that debt. So it cost an extra $5 million. But that was because that was an artificial increase in value because cap rates went down. So if cap rates would have stayed the same, we would have been fine. But even though we had to pay $5 million in a prepayment penalty, the value of the property went up $10 million. So yes, it costs us more money, but I'd rather protect the downside. We'd rather mitigate the risk than try and maximize the return. Okay? That's where we stay conservative.
On interest-only loans, that's strictly the lender, or do you negotiate that every time?
The question was interest-only loans. Does it depend on the lender? Do you negotiate that? Here's the thing. It changes. It's usually the lender will give you a term sheet to say what they will do. And there's, interest only or higher leverage, a higher rate. It's
So they want the business, but it's a
they want the business, but it's kind of like one of those balloons. You squeeze one side, it gets bigger over here. They're going to make their money one way or the other, so they'll adjust that balloon. Oh, you want to pay lower here? Well, you're paying more over here. Okay.
game.
It's a game. Exactly. So that's what happened with. Yes, sir.
In this example, if the cap rate is 5% and the debt rate is 5% also, why even borrow at 5%, which is the same as the cap rate? Just buy it for cash
Okay.
and get rid of the debt risk completely.
In this example, as Nikolai said, it's a 5% cap rate and 5% interest rate. Why borrow the money anyway when you can go ahead and pay yourself that same 5%? Okay? Do you have an answer for it?
Not really, no.
Leverage.
Leverage,
Well,
leverage.
but that's zero leverage. You don't make any money on that debt.
No, you don't make money on that debt, but if just like that other example I was using in the other slide, if you own it 100%, if you have a $20 million property and it goes up 10%, you made $2 million if you owned it cash. But if you only put $5 million down and you use leverage and it went up 10%, now you made 40% on your $5 million.
But it works the other way too.
It works the other way too. If the property goes down in value, then yes, then you get hurt more. That's called the Sharpe ratio if anybody wants to look it up. And it's based on risk. And, for example, our house is paid off. It's a horrible investment to pay off your house, but it's safety and security, right? Okay. So that's why we do that way. Okay. So that is the magic formula on how that works. You can see how values have fluctuated based on interest rates, dramatically hurt or help. Cap rates then also adjust with interest rates, okay, and how the cap rates affect it. But all of those things, the cap rate, your interest rate, doesn't have any effect on the magic formula here. Okay? Yes, sir?
Cap rate also goes down with an capex as well. So when you improve the property, cap rate goes down, hence raises the value of the property as well.
Okay. Say that again?
Capex
Yep.
lowers the cap rate as well, raises the value of the property as well, right? If you bought a property at a 5 cap rate and you did the property improvement, that lowers your expenses, that increases your NOI, that raises the property value.
It does, but it doesn't affect the cap rate though. Okay, so
Cap rate doesn't go down with capex though?
the cap rate doesn't, the cap rate is a market cap rate on whatever the market's doing.
NOI get improved.
But the NOI, if the capital improvement, the money that you put into that, that's why we go in there and we have money for capital improvements. Now on the mark, for example, it's very little. We're not going to do anything. There's nothing we can do to really increase the value of the property. But some properties we put in $20,000 per unit. And for that $20,000 per unit, we want to see a corresponding increase in the rents, right? And a lowering of expenses. Because if you think, they know this firsthand, is that if you're doing a lot of repairs, You have more maintenance time. You might have to have more staff to go ahead and take care of those maintenance items. You've got more expense on taking care of those. Whereas if you do a CapEx program and you plan on going in there and rehabbing all the units anyway, that's all part of the CapEx program and not part of your operating expenses, which lowers your operating expenses and increases your NOI. Okay? I would love to hear any questions that you may have on that. That might have been confusing. Is there any from back there? Yes, sir.
I think, elaborate on what Anna was saying a minute ago, I think if you have put $20,000 into the door to take a property from a B minus to a B plus, for example, now you've changed the market in which the property is considered. So your cap rate for a B plus property is going to be a little bit lower.
A little bit.
Especially for B minus.
Yeah, okay, so to expand on what Dillard just said, he said that if you, which is the same point that he had, the cap rate I said doesn't change. If you put a lot of money into a property, then that cap rate, I'm going to go back. Would you rather have a 5% cap rate, 2 identical properties, one in Oak Cliff and one in Highland Park?
Careful, my mother lived in Oak Cliff.
In income, then you might prefer this one. Income is exactly the same. Identical property, identical rents, identical everything. Which property would you rather have? Same return, same everything. Highland Park, why? Appreciation, clientele, all of these. It's a higher demand property. Higher demand, you can think of this as a reverse auction. You could get the cap rate could go down or the value could go up because you take into account the risk of the asset that's the security for your investment. So yes, it is true. Dillard point that out. Yes, so that's true. So the same thing, when you improve the property, you could drop the cap rate a little, but not a tremendous amount.
Yeah,
Okay.
yeah, and to piggyback on that, you got to be careful. You're not really changing cap rate. What you're doing is you're changing your NOI. Your NOI will go up because it's a more desirable location, more desirable property, and therefore your rents will be higher. So you're not really going to affect cap rates as much as you're.
Not too much,
No.
but it will add additional demand.
It will,
which could
but
lower
we have
that
to be
cap rate.
careful. We don't change cap rates. We change NOI, and that's
Yeah,
what
that's
we
right.
do.
Exactly.
Darwin,
Yes, sir.
just one remark on that, Julian's cap rate explanation. When you increase the NOI, you actually increase your effective cap rate based on your purchase price.
Right. If it's the same, okay. So if we said, so NOI divided by your cap rate is your value. Well, the same scenario is true if you take your value or your purchase price divided by your NOI will come up with what the cap rate is. If you increase the income divided by that purchase price now gives you a higher cap rate. I'm sorry, lower cap rate.
No, higher cap rate. It's your effective cap rate. So you double your NOI, your cap rate also doubles. Your
No,
effective
it
cap rate
lowers.
based
No, it lowers it because the value's higher.
No, based on your purchase price, your effective cap rate.
But the sale price doesn't mean anything the day after you bought it.
It's a projection. What they do on that is they say project. I hate projections.
Okay, we're getting into nerd territory here.
Okay.
Okay.
But I will say that is that projections, all of this is all projections. Any pro forma you look at can be manipulated however they want. Okay? You see, these are just numbers up here. I can go up there and change a number and affect the value. The brokers do the same thing. The brokers say, yeah, the cap rate's only a 3 right now, but the projected cap rate is a 7 if you do all this other stuff. Okay? So they try and sell you on different reasons why it's a great deal. All brokers have great deals. Everyone's a great deal. No, they're not. Okay? That's just sales. Okay? So, again, like I said, that is extremely important. $1 in additional NOI is how much in value? $20. $1. That's why we look at every single dollar we spend on wherever we can save it. And again, that's the maintenance people that they might say, oh, we need to contract that out. That's why you need to be able to call bullshit. Say, you can fix that, or we can do that, or we can figure out some other way to do it. Okay? Because that $1 equals 20, especially when you're getting into a position of selling the property. Now I'm going to go ahead and tell everybody, when we sell a property, obviously we start to prepare it ahead of time so that we can move the numbers around so that, you know, if it's a capital improvement item that we have in expenses, we put it down below the line to increase that income, things like that. You guys correct me if I'm wrong. The apartment industry sucks, okay?
Which side of it?
Well, the management side of it sucks. It's a ton of work. The amount of work those ladies back there put in is unbelievable. And 90% of the time, it's just being bitched at. Okay? And
Or hold on, as I like to always say, people come into your leasing office for two things, right? Two things and two things only. One, to talk to you about potentially moving in or to bitch about something. That's it. Am I right? That is it.
okay, now, also in this industry, owners will switch out management companies because third-party management company sucks too. Okay, they are a business in the business of managing properties. So they'll pick up some, they'll lose some, they don't care about that one because it doesn't really matter, they're in and out. So they don't do a very good job, third-party management. And for the managers and on-site staff, they kind of live in constant fear. Not necessarily constant fear, but it could at any time, a management company could, an owner could switch management companies. And from our point of view as owners, we've got to do what's best for the property. If it's switching management companies, that's one thing. But it affects everybody on site. So there's a little bit of fear and trepidation, which is one of the things why it's really good to work for an owner-operator. You know what's happening. Every one of them is nodding right there. Okay, it's because it's not third-party management where they can lose it anytime. However, the same thing is true if we decide to sell a property. If we decide to sell it, there's a lot of that. You can see how we need to change things to increase the value of the property. What we do then is we make them part of the solution to all that. Is generally speaking, we want to go ahead and keep, if they're good, we want to keep them and put them on a different property. That's every management company, they always do that. As soon as they're selling a property third party, they pull the good people off, put them on other ones and stick the people they don't like on those properties that sell. Trying to be nice about that. But we also have bonuses that we pay through that. I'm trying to find a way. I've done this on one other property. Everything we've done is to align everybody's interests. So everybody has the same motivation. On site, leasing agents used to get very high commissions. What's the problem with that? Constant turnover. They get paid on turnover. Okay? So that doesn't align our interests. That costs us more money. Okay? So now the leasing commissions are actually pretty low. But we still have to give that because there's work involved and we want to motivate them to go ahead and do that. Renewals, on the other hand, are better for us. Okay? And then renewals that have different increases are better for us. So that's how bonus structures are built. One property I did is I treated the manager like an owner, that there was no bonuses, there was nothing, okay? You tell me how you feel about this. Okay, no commissions, no bonuses, no nothing. However, when owners get paid, when there's a distribution, they get part of that distribution just like the owners.
A lot of
blank stares back there, okay. Okay, So, but again, we try and do everything we can to align interest, and that's why policies are in the way that we do that. And all of that goes back to that same magic formula: increase the NOI, lower the expenses, increase the rents however you can. So, any other questions? All right, thank you so much for coming. Meet whoever you can. Who's new here? Holy crap. Okay, make sure you meet some other people. Who's been investing with me for at least 3 years?
Oh,
Okay.
forget that. How about 5 years?
5 years.
How about 7 years? Look at that.
Okay.
See?
So if anybody that's new, don't take our word for it. Talk to the people that have been investing for a long period of time. That's the best way to do it. They'll shoot you straight and tell you what's good, bad, ugly, etc.